So my name is Jordan Matsudaira. I'm a associate professor at Teachers College at Columbia University, and I'm going to be moderating the next panel discussion. But before we do that, we're going to have our two experts come to us and switch the focus to a particular policy which has gained currency in the policy debate recently, with the White House back in the spring proposing debt limits, so limits on federal borrowing, at least for graduate and parent borrowers. So to discuss the issue of loan limits, we're going to have two experts come and talk to us, Matt Chingos from the Urban Institute and Leslie Turner from Vanderbilt. Matt Chingos is Vice President at the Urban Institute, where he directs the Center on Education, Data, and Policy. He earned his doctorate in government at Harvard University and previously served as a senior fellow at your Brookings institution. He's written extensively on higher education financial aid and accountability policy and helped policymakers understand the implications of his work in frequent testimony before Congress. Together with Beth Akers, he's the author of the book Game of Loans, The Rhetoric and Reality of Student Debt, which is an excellent synthesis of data and evidence that explains the rise of student debt levels over the past several decades and clarifies the most important problems with the current system in areas of reform. Dr. Leslie Turner will go second and is an associate professor of economics at Vanderbilt and a faculty fellow of the National Bureau of Economic Research. She earned her doctorate in economics from Columbia University. And her research, a lot of which we'll focus on in our conversation, is broadly focused on how the design of higher education finance programs affects colleges and students and has probably contributed more to understanding those issues than any other economist in her generation. She's been actively involved in policy as well, recently completing a year-long fellowship with the Senate Help Committee, lending her expertise to the debate over reauthorization of the Higher Education Act. So we look forward to both speakers. Matt?
Well, thank you for the introduction. Thank you for inviting me. It's great to be back at Brookings. So I just wanted to start by saying how glad I am that we're talking about loan limits. And the reason is we're hearing a lot about student loans these days. On the campaign trail, we're hearing a lot about proposals to forgive student loan debt, to make college free, but we're hearing very little about what to do about the student loan program itself. And I think maybe something people either don't realize or don't think about a lot is that we could forgive all of the outstanding student loan debt tomorrow, as Senator Bernie Sanders would like us to do, and we could make public colleges tuition free, but we'd still have a student loan program. People would still borrow for their living expenses to go to college. They borrow to go to private nonprofit colleges. They borrow to go to for-profit colleges. They borrow to attain graduate degrees. We'd be making loans to parents. So we could forgive all the loans tomorrow and make college free in all the ways that people have talked about, and we'd still have a student loan program. And what the folks who want to forgive the student loans and want to make college free haven't talked about is what they would do about the student loan program. So I think this is a great opportunity to start to have that conversation and think about, well, regardless of what we're going to do for the debt that currently exists, what should we do about the debt going forward? On what terms should we make loans to students in a way that's going to produce the outcomes we want both for the students and for taxpayers? So to just kind of put a couple of ideas out there, kind of just to get you thinking about the pros and cons of loan limits. Why do we have these limits? Well, the pros are we protect students from borrowing too much, at least to the extent that too much is above the limit that we put in place. And we use them to try and protect taxpayers from unpaid loans. So if we let anyone borrow however much they want, no questions asked, we might worry that a lot of that debt wouldn't get repaid. So if we put a limit in place, then that maybe would be less of an issue. What are the cons? Well, the cons is if we put a limit in place and the optimal amount for someone to borrow is $12,000 and we only say you can borrow $10,000, well then we're leading them to make a suboptimal choice, and maybe they're going to borrow too little, and instead of borrowing that extra $2,000 because we won't let them borrow it, they're going to take on a few hours at their off-campus job and get distracted from their studies, drop out, and actually lead to a worse outcome and be perhaps more likely to default than if we just let them borrow a little bit more. And the other con is that we're often going to end up with a one-size-fits-all approach. And I'll talk in a minute about how there is some variation in the limits for different kinds of students. but there's not that much variation, so it's more or less one size fits all and doesn't allow maybe the kinds of targeting we could imagine being ideal in terms of, well, what's the right limit? It probably depends on the student and the program they're going into and the field that they want to go into after that. So to begin with just an overview, a lot of folks don't know what the limits are, so here are the loan limits. For undergraduate students, we have annual limits, and they're different based on whether you're a dependent student or an independent student. And if you're a dependent student, that means you're age 24 or under, and you meet a few other characteristics. So if you're over 24, that means you're independent. And if you have kids that rely on you for support, you're independent, and there's a few other circumstances where you could be independent. The other way you can get not to be independent, but to get the loan limits the independent gets is if your parents apply for one of these parent loans that we've talked a little bit about, the Parent Plus loan, and you get rejected, then you can also get that. That's the other way to get that higher limit. So what you see is the federal government lets you borrow more each year for your first year of college. So first year college students can only borrow $5,500 from in terms of federal loans if they're dependent, $9,500 if they're independent. And once you're a third year or beyond undergraduate, you can borrow $7,500 or $12,500. There's also a lifetime limit for undergraduates in terms of your federal borrowing, which is $31,000 for dependent students and $57,500 for independent students. So this really speaks to when you hear the big numbers in the news, when you hear about the Adams dentist with $1 million in student, Josh's dentist with $1 million in student loan debt and driving the used Tesla, right? I think that anecdote will live on for the ages. That person clearly has blown through their lifetime limit, and it's because, right, someone like that is borrowing for graduate school, not just for an undergraduate degree. And then for graduate students, I could make a separate table for them, but it basically would just be a table saying they can borrow as much as they want, up to the cost of attendance, less grants that they receive. So there is really no limit on what graduate students can borrow. As Adam said, they can borrow tuition fees, living expenses as estimated by the college. And one thing to note is that the limits are the same for part-time and full-time students. So whereas when you get your Pell Grant gets prorated if you're enrolled part-time. But your student loans, you're eligible for the same amount. So part of the way you can hit that lifetime limit is if you sort of do the math and start adding up 55, 65, 75 times 2, you don't quite get all the way there. Whereas if someone is enrolled part-time, sort of for 5-6 years, you pretty quickly can run into those limits. If you're less than half-time, you're not eligible, but there's no kind of phase-in. Either you're eligible for the full limit or you're not eligible. So I thought just to kind of provide some context on, well, how much do these limits matter and for whom do they matter? Went to one of the federal data sets on this and said, well, let's take a look at how much people are borrowing. And we'll first look at undergraduates, then we'll look at bachelor's degree folks, and then we'll look at graduate students. So here I'm putting people into 4 different categories. So just looking at all undergraduates in a given year, this is data from 2015-16, you could not borrow, not take out a federal loan. You could take out a federal loan, but borrow less than your personal limit, because that reminds me of something I forgot to tell you on the previous slide, which is there's an additional limit, which is that you can't borrow more than the cost of attendance, less other grants received. So if you're an undergraduate, and this really applies more for undergraduate students, so if you're an undergraduate student and the cost of attendance, tuition fees, living expenses, and all that is $10,000, and you get a Pell Grant for $6,000, you can borrow the extra 4, but you can't borrow more than that. So for some students, you can have a personal loan limit, which is actually less than the table of program limits I showed you a moment ago. So that's the second category, which is folks are borrowing less than that personal limit. So they're not maxing out their federal loans. There's a third category of folks, and these are folks who are maxing out their eligibility for federal loans. They're borrowing their personal limit. But for this group of folks, their personal limit is less than the program limit. And the reason it's worth knowing this is because we could imagine policymakers saying, well, maybe we should relax that limit and just have the same program limit for everyone. And that gives a sense of, well, how big is that group? And then the final group of folks are those who are borrowing the program limit. They're borrowing one of the numbers on this table. And what you see here is that it's easy to forget with all the talk about student loans. Lots of folks don't borrow. In general, about half of undergraduate students in a given year aren't borrowing. At community colleges, there's the largest rates. 80% of people are not borrowing in a given year at public 2-year colleges, so 20% are borrowing. At the other sectors, it's all around 35, 45%. Then you see the next group borrowing less than their personal limit. Once again, public 2 years not borrowing very much, but that's about a quarter of people are borrowing, but less than that they could. It's a very small number of people, around 5% across all sectors, that are hitting that personal limit, and they actually could borrow more if we would just relax that cost of attendance limitation. And you see the final group, once again, setting aside the community colleges, which is a pretty small group of borrowers. It's about 30%, depending on sector, that are hitting that program limit. So about 1 in 5, 1 in 4 students or so are hitting that program limit. So if we turn to cumulative borrowing, this is looking at bachelor's degree recipients. So they're leaving college, and we can look at whether they hit that lifetime limit. So now there's 3 categories. You didn't borrow, you borrowed less than your lifetime maximum, or you hit the lifetime maximum. And what we see here is about a quarter, 30% or so, are leaving college without any debt. About 10% are hitting that lifetime maximum, and then the rest of them, I guess about half of students or so, are borrowing but less than that lifetime maximum. You do see here that the lower your income, the more likely you are to hit that lifetime maximum, and that can reflect your lower income. You need to borrow more money. It can mean you're enrolled for a lot more semesters, you're part-time. It could be you're enrolled at institutions that charge more or people borrow more. And you see that as you go up the income distribution, people are less likely to hit that lifetime maximum. If we look at the same numbers by race, we see some numbers that are consistent with some other data we've seen today and other data that have been published showing that Black and African American borrowers are most likely to hit those lifetime maximums and least likely to not borrow at all. So whereas all students, about 3/4 are borrowing, so a quarter are not borrowing. Whereas among Black or African American borrowers, it's less than 20% that are not borrowing at all, and more than 20% that are hitting that lifetime maximum. Whereas white, Asian, and Latino borrowers tend to look more similar to each other. If we turn to graduate students, once again, now the limit is just this cost of attendance limit, but we can look in the data and see who's not borrowing, who is borrowing but less than their cost of attendance, less grants, and who's hitting the limit. Not huge numbers of graduate students hitting the limits, about 20%, depending on, once again, looking at racial and ethnic groups here, a bit of variation, highest numbers hitting the maximum among Black borrowers, but all sort of in the range of, 15, 20, 25% or so. So as my time ticks down here, just going to throw out a couple of possible changes we could think about as we hear Leslie's comments and then head into the discussion. We could think about not lending to students attending institutions or programs with weak outcomes, so basically what Adam and Dubravka talked about. We could think about reinstating the limits on graduate student borrowing, which had been in place but were lifted in 2005. And we could also think about allowing institutions discretion to raise the undergraduate limits on a case-by-case basis, perhaps doing some kind of targeting to those with strong records of repayment. So try to move a little bit away from the one-size-fits-all approach to providing some more discretion. And I'm not endorsing these. I think they have some pros and cons that'll make for some good discussion. So thank you.
I'm very pleased to be here to continue this discussion on policies around changing federal student loan limits. And I'm going to focus my remarks up here on the potential benefits and costs of restricting or increasing students' abilities to borrow from federal student loan programs. And I just wanted to highlight one thing before I proceed, that I'm really going to be talking about policies that affect students' ability to take out federal student loans and don't change any other features of financial aid programs. There's a whole host of policies that could change how much students borrow, from varying grants to free college, and those likely have a different set of costs and benefits and effects on students. Okay, so I'll start with the potential benefits of lowering federal student loan limits. Okay. One of the biggest concerns around student debt and the outstanding or the student debt crisis is concerns that borrowers are taking on more debt than they are able to repay. And one potential benefit that's often discussed about limiting the amount borrowers can take up is that this will prevent them from taking on this debt that they won't be able to service after they leave college. This will reduce payment difficulties, loan delinquencies, and loan defaults. What does the research and data say about whether this is a concern? Well, actually, loan default rates are highest for low balance borrowers. And this seems like a surprising finding, but when you dig in a little bit more, these are actually borrowers who are much less likely to have completed their program. So low balance non-completers, these are borrowers that sort of have borrowed $10,000 or less, are about 3 times as likely to default on their loans compared to higher balance college completers. Okay. So it doesn't seem like, at least in terms of repayment difficulties, the problem is with loan limits. This is more a problem of getting students perhaps into the right colleges where they'll be more likely to succeed, or getting them to the finish line so they can get that degree or credential that we know will provide them with higher earnings on average in the labor market. Okay. A second potential benefit, which I think we'll get into more in the very final panel, is that reducing the amount of loan debt could also limit negative spillovers to other financial markets or to the macroeconomy. One of the often cited concerns about increases in student debt is a concern that it's limiting young adults' ability to become homeowners. And if you just look at trends in aggregate data, we can see that as student loan debt has increased, homeownership rates for young adults have decreased or leveled off. But these aggregate trends are really hiding a lot of other factors, such as the Great Recession, which limited families' finances, also increased lending standards, both of which could lead to these patterns. And the evidence is really, despite what is written about effects of student loans on homeownership, the empirical evidence is fairly limited as to whether this is a big concern. A second type of spillover is effects on borrowers' decisions to become entrepreneurs or start a small business. And we do see that in counties with higher levels of student loans, there are fewer small businesses being formed. But this is an area, again, where we're not quite sure, is this a causal effect, or are there other factors that are leading to both of these outcomes? And a final potential benefit, which was touched on in the first panel, is that by restricting the amount students can borrow, schools will be less able to increase their tuition or charge very high tuition, like the online social work program that Adam talked about. And there is some evidence that for non-degree for-profit institutions, federal student aid allows them to charge higher tuition than they otherwise would be able to. But where we've seen really big increases in loan limits is in graduate programs, where these limits were taken away starting in 2006. And we just really don't know enough about whether putting these limits back in place would help hold down increases in prices. Almost all of the discussion and research on this quote-unquote Bennett hypothesis that federal student aid allows for tuition increases has focused on undergraduate borrowers. Okay. And then what about implications for taxpayers? So this gets a little bit more complicated because of the way the CBO calculates the potential costs of federal loan programs. Depends on what program we're talking about and what accounting method CBO is using. And I'm not going to get into the nitty-gritty details, but for undergraduate loans, CBO generally finds or reports that these cost federal revenue. So reducing borrowing through undergraduate programs would be a benefit to taxpayers. For graduate loans and Parent Plus loans, CBO calculates that these programs actually make revenue for the federal government. So restricting limits or putting limits back on these programs would have budgetary implications that are different than what are often talked about. Now, whether or not this is true is a matter of debate, and probably these calculated subsidies or the profit that the federal government makes off of graduate and Parent Plus programs will change in the coming years as more graduate borrowers participate in income-based repayment. But this has important consequences for discussions around policy and legislation that would put limits back on these programs, okay? Because if such policies cost money, these costs will need to be offset by changes to other programs. Okay, so finally, let's turn to the other side of this equation. What are the potential costs of lowering federal student loan limits? Okay. The first potential cost is that students who would have borrowed that extra $1,000 through federal loans, but now they face a lower limit and so they can't, might have to shift to more costly forms of debt. They may need to turn to private loans, which don't offer the protections of income-based repayment, or they may need to turn to a credit card to finance their college education. Okay, and we can look at the most recent nationally representative data and see, at least there's a correlation between foregoing federal student loans and using a credit card to pay for college. So among undergraduates who have unmet needs, so they have costs that are not covered by grants, those who do not take out a federal loan are 33% more likely to report using a credit card to pay for tuition and fees than those who do use a federal loan. We can, debate whether or not this is good or bad. Credit cards have much higher interest rates than federal student loans, but they are dischargeable in bankruptcy. But at least there is some very suggestive evidence that when students forego federal loans, they are going to, that money doesn't come from thin air, they have to make up for it somehow. And so they may turn to credit cards or they may decide to work more, which will reduce the time they potentially have available for classes. Okay. And then the second potential cost of lowering loan limits is that this could have implications for students' attainment. And this directly flows from this first cost. In the current system of grants and loans, if students can borrow less through federal loan programs, they have to make up for that money. Okay? They have to use a credit card, a private loan, or they potentially have to work more, which takes away time that they can spend in school. Okay, and this is where my own research can shed some light, at least in terms of community college students. So in an experiment where community college students were randomly assigned to receive recommendations of federal loans or not have loans recommended, those who were recommended federal loans were more likely to borrow. They also attempted and earned more credits, received higher grades, and were more likely to transfer to a bachelor's degree program. And we can say it in the converse way, which is what it says here, when students are induced to not borrow because of the recommendation they get from their college, okay, they do worse in school, and they're less likely to progress to a higher payoff program. Okay. There's also research that has looked at the decision of community colleges to leave federal loan programs. Okay, and so in these schools, students can't borrow through federal loan programs even if they want to, and it seems like the decision to not offer federal loans also has negative consequences for students. Okay. Now I should note all of these three studies focus on community college students, and we really don't know what would happen in the four-year sector or for graduate students, but to the extent that community college students are the sort of most likely to be low income, more vulnerable to changes in federal policy, this should give us real pause when we think about policies that would make it harder for these students to take advantage of federal loan programs. Okay, and finally, and we can discuss this more in the group, I'd like to talk a little bit about what is the response to the student debt crisis around loan limits. Okay. Institutions have focused almost exclusively on policies that would reduce borrowing. So community colleges have opted out of federal loan programs. This is about 9% of all community colleges. There's colleges that do not offer loans to students in their award letters, and this is what the college that I studied was deciding whether or not to do. There's colleges that send informational letters or know your debt letters that talk about how much payments are going to be after graduation to high balance borrowers or to all borrowers. And then there's schools that have implemented comprehensive debt reduction initiatives that include financial literacy courses and campaigns around borrowing less. And so at least from an institutional perspective, these schools seem to think lower loan limits or limiting borrowing would be a good thing for their students. at the federal level, there's been a lot of discussion around policies, but really the only experimentation we've seen has been at a limited number of institutions through the Department of Education's Experimental Sites Initiative, where these schools were given discretion around setting lower limits for students in certain programs or for students in certain groups. And we really don't have much evidence about the effects of these policies. So there's a lot still to be debated and learned, and this is where we will turn to next. Thank you.
Okay, great. Thank you both for those excellent presentations. I guess I want to pick up in a place where Leslie left off, and Matt, kind of bring you into the conversation, which is, one of the things that Leslie was saying is that a lot of the people that we see struggling the most to repay their student loans are actually those who are borrowing relatively little, perhaps because they're not completing. And so, there's less that we know perhaps about graduate borrowers and Parent Plus borrowers, but I wonder just on the, if we stick to undergraduate borrowing for the moment, whether and give you both a chance to answer, what scope you think there is for restrictions, so limits on student borrowing to really help.
So I guess my remarks focus more on other people for whom we should raise limits,
Yeah.
but there's clearly the flip side of other people for whom we should lower the limits. And as you noted, a lot of folks with lower balances are struggling. So there is this kind of factoid out there that the lowest balance borrowers who are most likely to default, and that's true. But if you look at the relationship across the distribution of borrowing, it's not, my understanding is it's not that strong. So there's people struggling at all points along it. So it has to do with how much you borrow relative to how much money you're making. So what do we do about that? I think there's the insurance mechanisms we talked about on the income-driven repayment programs to kind of try and protect the student from the consequences of that. But then there are also the efforts to try and deal with it in the first place by limiting lending to places that have a track record of not great outcomes. So I think clearly there's a lot more that needs to be done there. And it's obviously tricky. How do you do it to balance this desire to provide access, but not access to bad things? But clearly we haven't gotten that balance. We'll never get it perfect, but I think there's a clear case to be made for shifting it towards greater restrictions of where you can borrow.
So a lot of my research has focused on policies that colleges and universities are implementing around borrowing. And one thing to note is that the plurality of undergraduate students are attending open access community colleges. When we look at how community colleges are making policy around federal loans, these schools have almost exclusively been implementing policies that make it harder for students to get access to federal student loans. There's the 9% of schools that have opted out of federal loan programs, and then about 50% of the remaining schools don't offer students federal loans. Students can still borrow, but there's additional administrative hurdles they have to go through, and perhaps they don't think that loans are available when they're not offered loans in their award letters. And so even in the absence of federal action, I think there's still an important conversation to be had around these decisions that institutions are making out there. The decisions are different for schools serving bachelor's degree students and graduate programs, and I think this is where the debate should focus when we're talking about reducing borrowing, especially for grad students.
Yeah, so just picking up on that, I mean, so in the graduate space, which I think is where more of the attention has been focused on the idea of setting just caps on federal borrowing, how do we balance this idea of trying to protect students from acquiring too much debt versus limiting access to potentially programs that could be high value? So Leslie, I know that you've done some work on that recently on the Hill and thinking about the HEA conversations. What's a good way of kind of balancing those two competing goals?
So in 2005, when there were limits on graduate borrowing, the limits were about 18,500. So if we inflate those to today's dollars, it's around $25,000 per year. Looking at nationally representative data of graduate students across all different programs, only about 11% of graduate students are borrowing more than $25,000. So this is sort of a relatively small number of students that could be affected, even if we put back in place these relatively low limits. For the students that are borrowing more than $25,000, most of them are in programs that we would hope, perhaps not exclusively, but we would hope to be high return. Law, medical, and to some extent, MBA programs. And these are programs where in the past, students may have turned to private student loans, which, there's definitely trade-offs involved there. Private student loans do not offer income-based repayment. But in many cases, they may actually offer lower interest rates than the graduate plus loans that students can borrow up to the cost of attendance.
I'd just add that when you think about the graduate lending program, you also need to think about not just on its own, because on its own, the program made money, at least by some accounting standards, on paper, until recently. And now that we've kind of layered the unlimited borrowing to graduate students with relatively generous loan forgiveness programs where you pay 10% of your income for 20 years and get the balance forgiven, and especially when you pay 10% of your income for just 10 years in the public sector, where we now have a situation where people could make a reasonable investment, make a loan that was a fine loan to make a fine income, but end up getting this huge subsidy from taxpayers in the back end. And maybe that's a fine thing to do, but I don't think that's really what Congress intended to do when they created these various programs at different points in time. So I think also we have to think of the taxpayers as kind of a key stakeholder here. And if we're spending billions and billions on providing relatively large subsidies to graduate students who do fine, while we still feel like maybe we're not doing enough for low-income undergraduate students, in terms of the Pell program, whether we're getting that balance right, and whether there's a shift that ought to be made there.
Just picking up on the point that Leslie was making about relatively few programs being hit by these caps, what sort of ideas would you have to just prevent students who might have difficulty accessing private lending markets, or just the students who might be kind of really affected by this, have their access to high value programs be cut off by federal caps? What other kinds of things could the government do to kind of avoid those kinds of adverse consequences?
This is a good point that Jordan raises, and I think that one of the biggest concerns around putting limits back on graduate borrowing is that students from especially low-income backgrounds and underrepresented minority students won't be able to access these high-cost programs because of how private lenders determine who is creditworthy. Students aren't guaranteed access to private student loans. And so I think there's two ways to deal with this through financial aid, providing grants to these students, or having higher loan limits for particular programs where we're worried this will be especially the case, such as medical programs.
I'm curious, are either of you aware of any evidence? That was the state of the world until 10, 15 years ago. Did opening up Grad Plus in an unlimited way, did that suddenly lead to folks who getting high value credentials they couldn't get before? It seems like an area where at least maybe the private market wouldn't perform perfectly for graduate students, but it would certainly perform better than it would for undergraduate students, right? Because an undergraduate thing is kind of more amorphous, where graduate degrees tend to be pretty specific, pretty geared towards, generating gainful employment in particular occupations. But are either of you aware? If I'm allowed to ask a question.
It was going to be one of my next questions for you.
Oh, good. I'm glad I asked it. Rather than getting asked it.
So well played. Leslie.
So I guess it falls on me to say I am not aware of evidence, but it is a great question that researchers out there could and should be looking at.
Okay, so another question that I had, and Leslie, this is kind of a question that's provoked by some of your work, which is, we do grant institutions a lot of discretion over the kind of nudges, the recommendations that they make when they're packaging aid to different people, and this, the upside of that seems to be like the potential to kind of right size the financial aid decisions that students are making. But the thrust of some of your work suggests that institutions aren't really taking advantage of that. If anything, there's kind of still a one-size-fits-all kind of approach to the students that institutions serve, and it tends to be just to take the option away for the most part, or at least to not advertise the option. So I wonder just whether you think that there are kind of recommendations or policy that could affect the decisions that practitioners are making when they're packaging aid.
That's a great question. So just a little background on federal student loans. For schools that are participating in federal loan programs, they can't restrict a student's ability to borrow unless they're in one of those experimental sites that I mentioned. But they have discretion over the amount of loans they recommend to students. So they might recommend the maximum amount a student could borrow, which Matt showed us. They might recommend some smaller amount. They might recommend no loan at all. And again, about 50% of community colleges don't recommend loans to their students. And this seems to be especially impactful for students' borrowing decisions, as shown in the study that I alluded to. And at least at the community college level, my research suggests on average, if you have to do a one-size-fits-all policy, that offering loans or recommending loans is the best policy. But especially for outside of the most selective four-year institutions, students have incredibly heterogeneous circumstances. They are not living in dorms, they're living off campus. They face different costs in terms of rent, transportation, and the way that colleges determine this cost of attendance is a one-size-fits-all approach. So if you're living off campus, the school assumes you're going to face this much in costs. And I think there is a lot of room within the way schools determine cost of attendance to be more responsive to students' unique circumstances. A student that is paying $500 a month in rent likely, all else equal, likely needs to borrow less than a student that has to pay $3,000 in rent. But as far as I know, colleges treat these two students entirely the same in terms of determining cost of attendance and in terms of loan recommendations.
And so do you think there's a role for policy in trying to affect behavior at the college level?
Yes, I do think there is. Most financial aid administrators I've talked to about trying to introduce some nuance into their loan packaging and loan recommendation practices are incredibly hesitant to do so because they worry about running afoul of Department of Education regulations. And so I think, in the very near future that there could be some guidance that would allow schools not to restrict loan access, but to allow for more nuance into the recommendations they make to students. I think, at the end of the day, however, at least for community college students should be made aware of their loan options. Even if they are not recommended a loan, they should be made aware that these loans do exist.
I think it's also worth mentioning that even when whatever they do offer or don't offer can often be very confusing for students. So I think there was the New America folks who in the last couple of years went and looked at all the aid award letters, and a lot of times it wasn't clear that you were being offered a loan. You were offered like a direct on sub. It's a direct unsubsidized loan, but we just said it was a direct on sub. And it's also consistent with some evidence tonight that Beth Akers and I put out in a Brookings study about 5 years ago now, finding that if you looked at just at first-year college students in these data sets, they couldn't give you a very accurate indication of how much they borrowed. So of the people we know from the federal data had a federal loan, 28% said they didn't have a federal loan, and 14% said they didn't have any loan at all. So this isn't to say that some kind of financial literacy campaign is going to solve this problem and fix all the problems, because there's still other challenges, but it does seem like it just would be good if people understood what it was they were doing.
Yeah, that's a good segue to another point, which is, traditionally, when economists have thought about this question of whether people are borrowing too much, the kind of main or the kind of the exclusive lens through which we think about that question is whether the amount that people are borrowing is a good investment in the sense that the earnings returns on that borrowing are really going to justify a given amount of borrowing. That kind of presumes that students know something about what they're getting into, both on the kind of cost side, which is related to the kind of confusion about what loan product they're actually using, but also on the outcome side. Matt, I know you and your colleagues have done work on that question as well. So I wonder, what you think about what more the federal government could be doing to make sure that students are informed, and whether you're kind of bullish on whether those kinds of ideas would help to allow students to make good enough decisions about borrowing decisions and so on, that we'd really see meaningful changes in their outcomes.
This is an area that's really challenging. I mean, in principle, we want people to be making informed decisions. We want them to be making some kind of optimized investment decision. Should they kind of borrow the right amount to attend the right program to get the right sort of return? But yeah, in some work that colleagues and I did over the last few years, when we went out and tried to create that information, build a nice website, push it out to high schools. Like, if the high schools weren't that interested, they said, our students have lots of information. And high schools that did participate, there wasn't a big take-up of the informational interventions we've created. I think we've seen some similar evidence from the college scorecard that, yeah, of course it's good. It's good you all did that. It's good the data are out there, but not a lot of evidence that it's changing behavior across the board. And I think part of the problem is it's hard for an 18-year-old or a 25 or 30-year-old potential college student to make sense of this information. But if you think about, just wearing my own hat, how hard it is to make sense of this. Like, how much should someone borrow? Well, if someone says, should I borrow $200,000 to become a surgeon? I'd say, yes, that's probably a reasonable thing to do. They said, should I borrow $100,000 to get a master's in film studies? I would say probably no. It's probably a bad idea. Right? Should I borrow $10,000 to go to a for-profit college with really bad outcomes where no one graduates or gets a good job? Don't do that. Right? So there's these kind of obvious ones, but then the kind of mushy middle of, this college has a loan default rate that's 3 percentage points higher, but average earnings of the graduates that are $5,000 higher, but a graduation rate's at 3 percentage points lower. Like, should I go there or the other place? And whether I pick A or B, like, how much should I borrow? Like, I have no idea how to answer that question.
I think I used to be fairly optimistic about the ability of pushing out information to students and families to help improve decisions around where to go to college, what to study, how much to borrow, and to put some market pressure on these bad schools. If students know these schools are producing really poor outcomes, we would assume they wouldn't go. And all of the evidence to date suggests that even really high quality information like what's put out there through the college scorecard doesn't really move the needle, especially for the low-income students that are often the ones choosing between this community college as other for-profit institution, or should I study a health-related degree, or should I do an associate's degree in liberal arts? And so, I struggle with how to answer this question as well, although I think I go back to some of the comments that Adam made in the first presentation that, there is a role for the federal government to put some additional accountability pressure on either institutions or programs within institutions. We know there's a huge amount of variation in outcomes across programs. And, we can all, I think it's very tricky to think about what that system should look like, but I think, it's easier to agree on a very low bar. And if schools fall below this bar, then without a doubt, it is not a good investment for any student involved.
Yeah, on this question, I wonder whether you feel like we've kind of done enough, though. So things like the scorecard are just kind of making information available and kind of hoping people will come. And I wonder whether you think there's more of a role for leveraging intermediaries, like providing more personal assistance to people who are, at the stage where they're looking at different kinds of programs to really help them interpret the information to make decisions for them, which seems to be kind of the gist of some of the consensus around a lot of these more behavioral nudges, like in higher education, that have been coming out of kind of various economists working on the issues these days.
I think these programs have potential for what we think of as a traditional student, the one who's going through high school, graduating, and going to college immediately. There's sort of a point of access that this information and assistance can be provided. But, the college student off the street is 28 years old, working at least part-time, going to a community college. And so it's much harder to think of, how to access that individual at the point in time when they haven't enrolled yet, but they're deciding where to go. When it comes to student loans, we've seen schools experimenting with these know your debt letters. So if you're borrowed more than a certain amount, you get this letter saying, hey, you've borrowed a lot, here's what your payments are going to be, here's the, come to the financial aid office, talk to us. And these letters, students report reading them, they know they borrowed a lot, but it doesn't move the needle. They don't see really any other option. And so I think, again, I used to be very optimistic about information interventions, and it's true that there's more that could be done, but I think, they can only go so far in helping students make better decisions.
Jordan, you should turn to the audience. Okay, let me open the conversation up to the audience. We'll do the same thing as last time, which is collect a group of questions and then allow our panelists to respond.
Hi, my name is Deniz Karataş. I'm working at Bay Atlantic University in Washington, D.C. It's a non-profit university. It's a small one, a young university. Just as you're, talking about like bad universities, but it's like good one, actually, a good small university. So we have 250 students. And I have to say the regulations of the accreditation is, about accountability. We are accredited from ACICS, and it is, they are pressuring us, I have to say. We have to keep quality. So if, our graduation rates are like 100%, for example, and if it goes lower than that, or like the employability of the students are going lower than that, then we might lose our accreditation, which leads to, no students. You cannot get any students if you don't have the accreditation, obviously. So in terms of accountability, I think the system is somehow working for small universities. But maybe do you think, this question is for both of the panelists, do you think the general policy change can help, like the big, good universities like Georgetown, George Washington, the tuition amounts might be regulated because they are so high, they are like inaccessible for lower income students. If they borrow money or not, it's still inaccessible for the lower income students. So do you think that kind of, regulation might able to work for accessibility?
Thank you. Is there another question?
Yeah, thanks for your discussion. Carl Polzer. I do a lot of work in the retirement savings area, and there's a big discussion going on about whether the administrators of plans have a fiduciary duty or an advisory duty. And I think the same applies here. So that it seems from just this discussion that the students rely on the nudging that they get from the university financial aid office that say, hey, you're eligible for a loan. So in a way, they're providing advice by offering. But their main duty is to the university, and that it gets business. A fiduciary duty to the student would put themselves in the shoes of the student, both on the financial side and on the potential education side. So really, are they in the right position to give financial advice since they're at the university, since their main duty is to the welfare of the university, or should it be another party that gives advice to the student about whether to do this and where to do it?
Thanks for those questions.
I'll start with the second question first. I think even with a non-answer first, even beyond whether there's a conflict of interest by the financial aid advisor. I think there's a bigger question around just, do they even know, even if they have the student's best interests at heart, do they even know what the right amount is for the student? Maybe if they're able to sit down with a student, if they go through a budget worksheet and collect some information from the student's circumstances, but community colleges are incredibly under-resourced. They don't have the staff to do that, to meet one-on-one, and so I think maybe at the private institutions, the four-year institutions that are more resourced, where there is this kind of individualized counseling, this could be a big concern. I think at the community college level, it's really just not even in having access to a person and their time to get any sort of advice at all. And then when you meet with that person, do they have the training or the knowledge to help you make that decision?
I just had one quick point to that, which is it's interesting how different kinds of institutions have interpreted whatever that duty is to themselves, right? So a lot of the for-profits get criticized for this the most. They just push all the possible debt the student could get so that they can enroll them, and pay the bills. Whereas what we see more in the community colleges is an aversion to giving students debt, I think in part because of a fear about accountability, that if I give students the debt, they're going to have bad default rates, and then I'm going to lose access not just to the loans, which are a relatively small share of students at community colleges take, but to Pell Grants, which a very large share of students take. So there you see all the behavior that Leslie described around either not offering loans, either not being in the program or not offering the loans. So I think interesting how institutions have kind of pushed students in different directions.
So I think if someone wants to answer the regulate tuition question, we have time for that.
So, I keep harping back on the community colleges, but I think they're an important sector that often is overlooked in discussions around student loan debt and college pricing and college access. And community colleges and four-year public institutions actually are regulated in terms of their prices. In many cases, the state governing body or the state legislature has to approve tuition increases, and tuition, especially in the community college world, is fairly low. So I think there's trade-offs here. When schools charge less in tuition, they have lower resources, and maybe they can't hire as many financial aid advisors to help students.
Okay, I guess we're at time, so let's thank our panel. Thank you.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.